Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And welcome to this Q&A episode. Got some great questions to get through today, so thanks so much for sending them in. If you have any questions or feedback, you can send them to questions@investopoly.com.au. And also, before I get started, I've got a new report that you can download. So I've created a report that sort of outlines the kind of a comprehensive guide, if you like, to building wealth using evidence-based investment strategies to invest in both property and shares. So equal parts property and shares. And not only will it maybe be a great resource for you, the listener to this podcast, but also maybe, some family or friends that might benefit. Of course, that's sort of the hidden goal for me, is to kind of spread the word. And I think this report, I talk a lot about these evidence-based strategies. What I've tried to do with this report is bring it all together into this sort of comprehensive guide. So, of course, link is in the show notes if it's of any interest, and please do share, as I said. So let's get into today's listener questions. And the first one is from Christy. A little bit of a long one, but it touches on a really good point. So Christy writes, "Thanks so much for doing the podcast. I've been listening for years, and through your fantastic financial education, you've helped change my life for the better. Who knew finance and investing could be so fun?" Yeah, actually, who knew, Christy? Thanks so much for the great feedback. I have a question that I feel could relate to many of your listeners who have found themselves in a position of perhaps being inappropriately advised to start a self-managed super fund. My mother, who's 71 years old, has a self-managed super fund with a balance of about $350,000, which consists of some individual shares, IVV, which is an S&P 500 ETF, and a few listed investment companies, plus about $45,000 of cash. She's currently working about 30 hours and makes a good income, about $170,000, but she's getting tired and would love her to have the confidence to retire. She's in a stable de facto relationship of 25 years, and fortunately her partner has a very large investment portfolio and almost $2 million spread across his personal name and super. He will likely put more money into super from the cash that he has outside. I'll come back to that. My mother's super balance has really not grown very much over the years. She's making occasional withdrawals around $27,000 to $30,000 a year, and she contributes $27,500, obviously, in concessional contributions. She said it costs around $4,000 a year in accounting fees to run the self-managed super fund. It seems to me it's not really benefiting her by having a self-managed super fund, both from investing skills, she does all herself due to her low balance. How would you go about transferring to either an industry fund, such as UniSuper, or a wrap platform, which I've heard you discuss in the podcast, but don't really understand? What are the consequences of making such a move, such as capital gains tax, and wrapping up the super fund? Or is it simply applying to a new industry fund and let them do the transfer for you? I hope that makes sense. Thanks. Christy, great question around self-managed super funds and the benefits of them. And I can't help myself, and I actually didn't, it was in brackets, I didn't read this bit out, but your mum's de facto has $1.5 million in super and $400,000 in high interest saving account outside of super, which is, the 1.9, as I said, have rounded up $2 million. And you make the comment that he will potentially move some of that cash inside super in the next few years. You can bring forward 3 years of non-concessional contributions. So you've got concessional and non-concessional. Non-concessional are the after-tax contribution. So that's how you would make the contribution or move that cash into super. The cap is $120,000 per year, or if your balance is under 1.78 million, you can bring up to 3 years of caps forward and make that contribution this year. So 3 times 120, of course, which is 360. When you get to a certain amount, you can't use the carry forward, and then I think it's 1.8, I think something like that, you can't then make any non-concessional contributions. So I guess in his situation, it doesn't really relate to your question, but in his situation, if he's close to 1.5 in super, he's getting pretty close to not being able to bring forward those non-concessional contributions. And so that could be something he might want to think about, that is getting that money inside super maybe sooner rather than later. later. If he's age 65, it means he's met the condition of release, so he can always take it out in the future if he needs it. So I think locking up inside super isn't such a big deal. So if he's 65 older or pretty close to 65, I don't think it's such a big deal. Not related to your question, of course, but I couldn't help myself at least address that point. Okay, Christy, let's get back to your mum and a self-managed super fund with $350,000 in it. Now, it's not in her accountant's interest to say, yeah, let's wind up the fund. Of course, if he winds up the fund, it's actually a lot of work. He'll obviously charge a fee for that work, but you don't always end up, being able to charge enough of a fee to sort of compensate you. And then you lose that client, of course, you lose that fee revenue stream. So it's not in his individual commercial interest to wind it up. I would say in our firm, we wind up a lot more self-managed super funds than we establish. So, that should tell you something, I think, about whether they're worthwhile. Normally, if you wind up a self-managed super fund and transfer out, that is a CGT event. So it's something that listeners might want to take into account. Now, Christy, with your mum, she's obviously already in pension phase, right? So there's not going to be any capital gains tax. So that's fine. You don't need to worry about it. But for the people that are in accumulation that have a self-managed super fund, that's what you need to think about. And typically, if I've got a client with a self-managed super fund that's getting pretty close to starting a pension, I'll probably leave the super fund and then wind it up when they're in pension phase to avoid the capital gains tax. Okay, so what's the process that you need to go through? Well, actually, I found a page on UniSuper's website, and the page title is Transfer Your Self-Managed Super Fund Balance to an Industry Fund. That's the page title. So maybe if you just Google UniSuper, transfer your SMSF balance to an industry fund, you'll find that page. I found that there's a lot of information on that page. Essentially, what needs to happen is you need to instruct the accountant to produce the final set of accounts and returns. They will then need to have that audited. Then your mum would go and establish a account in UniSuper and then sell all the investments in the super fund. In fact, maybe you would do that first. Sell all the investments in the super fund. That way you're not going to trigger any more capital gains tax or income, so forth. Sell all the investments in the super fund, get the accountant to prepare a final set of accounts. Then your mum would need to contact UniSuper to trigger a rollover. That rollover needs to go via something called SuperStream, which is just an electronic way, a clearinghouse of rolling over monies. And it just makes sure that when UniSuper receive the balance, they understand the components of that balance, which are kind of related to those final set of accounts that your accountant needs to do. And then you're done. I find that process can take a couple of months because by the time you sell the investments and then by the time the accountant does all the returns and so forth and the final accounts and the audit, it can take a little bit of time. Now, why would you do it and how can you deal with, any pushback from the accountant? Well, as you said, your mum is investing in IVV, some listed investment companies, direct shares and so forth. Now, you're not going to pay any investment fees with direct shares, but you're going to pay investment fees with ETFs and listed investment companies. So you already pay those investment fees. UniSuper for balanced is going to charge you about 0.63%. So she's probably not paying 0.36% on investment fees in her super at the moment, but she'd be paying something, and that something's probably not too far away from that. But it's the administrative fees that are really killing her. UniSuper is going to charge her $96 a year versus she's paying $4,000 a year with a self-managed super fund. And that's what I would put to the accountant, is to say, I've got to make all the decisions, I've got to deal with all the paperwork and all the hassle, and whereas I don't have to do that with the industry fund. And when it comes to administrative fees, we're talking about $96 a year, I should say, versus $4,000. It's a no-brainer. And I don't think there's very much that the accountant could come back to you about in terms of trying to talk you out of it. So should she do it? An absolute no-brainer. Like someone in that situation, you want to make your situation simpler, not more complex, particularly as you get older. And I think as just natural as human beings get sort of closer to 80, their ability to sort of deal with these sort of more complex financial matters reduces. And I think for her and yourself, you probably want to get her in a situation where she's got a simplified arrangements rather than more complex. Great question, Christy. And I really love questions around self-managed super because I think a lot of people have self-managed super funds, don't really need them. Okay, next question is from Kirsty. It's about capital gains tax. So Kirsty writes, I'm hoping to get some options on how to handle an approximately $300,000 net cash after selling an investment property. I'm in the 37% tax bracket, earn about $170,000 a year as PAYG. I'm the only working member in our family. My wife does home duties looking after our 3 children. This will be a once-off event that will put me in the highest tax bracket and will result in a large tax bill due to this capital gains tax. So Kersey's obviously sold an investment property, netted 300 grand. Now he's got a big tax bill to deal with. We're thinking about paying off part of the home loan, but that won't help me reduce my tax. Apart from maxing out super contributions, are there any non-super options where I can reduce my tax in the coming year? Any general advice would be much appreciated. So obviously in this situation, the wife doesn't have any income, didn't have any ownership in the property. The husband, higher income earner, owned all the investment property, and as a result would have enjoyed all the negative gearing tax benefits, but the downside is then he pays more capital gains tax when he sells the investment property. So it's a challenge. I guess you've got to acknowledge that you can't always optimize both outcomes. You can maximize the negative gearing whilst minimizing capital gains tax. That's a challenge to achieve that. It's a good question, and whilst you ask for some non-super options, I would just say that in these sorts of situations, sometimes we purposely under-contribute into super if we know we're expecting a capital gains tax event in the future. So, for example, if I know my client is going to sell an investment property next year, I won't make additional super contributions this year, assuming their super balance is under $500,000, because what that will mean is it will allow me to use those contributions in the following year via making catch-up concessional contributions. So whilst we're thinking about this year and then we think, let's make some contributions into super, that's a no-brainer to try and reduce the capital gains tax. But I'm just sort of saying, if there's some planning opportunities, if there's some foresight and that there's a chance of crystallizing capital gains in the future, going out of your way to not make additional super contributions, as I said, if your balance is under $500,000, can be a good strategy to minimize capital gains tax. Unfortunately, though, as a PAYG employer, there's not a lot you can do, unfortunately, to minimize capital gains tax. It kind of is what it is. I guess the saving grace is even if you pay 47%, the highest marginal tax rate, you end up then paying, because of the capital gains tax discount, 23.5% in tax, but that means you keep the remaining portion, more than 3/4 of the capital gain. It's actually not a bad outcome, really. The only other things you can think about doing when you have a capital gains tax liability is, are there any investments that you hold that are in a capital loss position? Perhaps selling them. Be careful of wash sales, like selling them and buying them back. ATO doesn't really like that, but maybe selling them and at least crystallizing that capital loss in the same year that you've got a capital gain. That can help you in terms of reducing. And also, sometimes it can be worthwhile if you do have investment loans that are going to remain. So you sold investment property. If for example, Kirsty had another investment property, could potentially prepay interest as well. So it's called interest in advance, which essentially means that you crystallize sort of 2 years of interest expense in one. And again, that can help you minimize tax, particularly in a situation where you expect, where your taxable income this year is unusually high and it's going to fall in the future year. But great question, Kirsty. I think it really is about planning as well. So again, if I know my client's going to sell an investment property in the future, even if I know today we're going to buy one today and we're going to sell it in 10 years' time, I'm going to be thinking about, how do I balance up the negative gearing benefits, so maximizing them, but whilst also trying to minimize capital gains tax? So it's something to think about, because it can be a bit of a big hit. As I said, you keep 3/4 of it after tax, so it's not too bad. Better than not making any gain, but something to think about in terms of future planning. Okay, next question is from Tina, a really good one about helping children. And I suspect it's a topic, maybe I need to expand on it a little bit further and write a bit more of a blog about it. But it's a topic I suspect is going to come up more frequently. The perceived idea is that it's harder and harder to get into the property market. I say perceived there because I think there's some truth to it, of course, but sometimes it's overblown in some of the media. Okay, it's a long one, the question that Tina writes. I'm going to just try and simplify it as much as possible. So Tina and Jim, the parents of Oscar. Oscar is doing year 12, he's 18, and they want to get Oscar into the property market as soon soon as possible for obvious reasons. Tina and Jim's idea is to go and buy an apartment for $550,000 and gear it at 50%. So they'd put in $275,000 of cash plus costs and then go and borrow the remaining $275,000 for two reasons: so that it's a relatively low loan amount for Oscar to eventually take over the property, and also so that the rent covers most of the interest and costs, so that it's kind of neutrally geared, if you like. Then the idea is that, and they acknowledge to sell that property in, say, about 3 years' time. And I imagine Oscar's in year 12 this year. I imagine the 3-year timeline is, for Oscar to go to university and then to eventually have a job. So once Oscar has a job, hopefully that income is enough to qualify for a $275,000 investment or home loan. And if so, Tina and Jim, his parents, will sell the property to Oscar for the loan amount. So essentially just sort of transfer it, if you like. If it's under 600,000, the property, if the market value is under 600,000 at that time, Oscar as a first home buyer will be able to avoid stamp duty. If it's over 600,000, of course, then Oscar will need to pay for stamp duty. And they acknowledge that Jim and Tina might need to pay for some capital gains tax, of course, if there's any uplift to the market value, even though they sold it to Oscar for, the loan amount, $275,000, capital gains tax and stamp duty is levied on the market value. So that's their idea. And then they say that Oscar will initially occupy the property, claim it as his main residence, move out, go back home and put a tenant in it and have up to 6 years of capital gains tax free, which of course I've spoken about that idea in a case study previously, and it's a really good strategy. So very long-winded, but let me just summarize it. Buy an apartment, gear it at 50% so it's neutrally geared, then sell the property, essentially transferring the loan into the child's name, avoiding stamp duty if you're under that first home buyer's cap of 600,000, but realizing that you might have to pay for some capital gains tax. What do I think about the strategy? That's what Tina's asking me. I'd love to hear your thoughts on this idea in one of your Q&A podcasts. Okay, so Tina, what's the benefit? I'm just trying to sort of work out what's the benefit. I mean, I can look at obviously the benefit is that you get into the market today and you mitigate the risk of Oscar being priced out in the future. So if a $550,000 apartment costs me $550,000 today, of course, but if Oscar doesn't buy for 3 to 4 years, what will that apartment cost? So that's the benefit of your approach, or the suggested approach here, that I can identify. Now, if I've misunderstood that, I apologize and you should let me know. But what's the cost to doing that? Well, the cost is that you tie up more than $275,000 of your own cash. So there's an opportunity cost. There's the potential to pay capital gains tax. There's also the potential of actually locking in Oscar to paying for stamp duty. So for example, if the market value of the property is $650 and you hadn't have bought that property, well, Oscar then has the choice in 2 to 3 years' time actually buying at $600 and avoiding stamp duty. So whether you pay for the stamp duty on Oscar's behalf or he pays it, but essentially locking yourself in. And then there's a little bit of lack of flexibility there. So, because you've kind of locked in exactly how it's going to work out, but you don't really know, when Oscar's going to get a job, what job that might be, whether Oscar's going to be great at managing cash flow, whether Oscar really wants to own a property, all those sorts of considerations. Now, I'm really conscious that this is not a parental counseling sort of podcast. And nor is it anyone's business to dictate or coach or direct, how parents might want to interact with their children or parent their children. That's a very personal matter that, I don't seek to get involved in. Unfortunately, though, there are some elements of this in this strategy, right? So what I'm going to do is I'm going to share my viewpoint and my approach to this. And I certainly acknowledge it's not pure financial planning. So, I'm sort of bleeding over into areas where I don't really necessarily want to go. But unfortunately, it's so intertwined with this issue that you can't really pull it apart. But also, I'm going to say that, it's not for everyone. Like, this is my approach. I'm not saying that any other approach is wrong. It's just the approach that I'm employing. And it's interesting, Tina, because my sons, both of them are finishing year 12 this year as well. So very similar age and situation to Oscar. So the first thing I would say is you can't motivate someone to build wealth. I tried to do that for many years in my business, and we just worked out, well, we don't work with unmotivated people. We only work with people that are already motivated to build wealth. So it needs to come internally. And I know, from experiences with clients and just general life experience, parents can do everything they possibly can do to educate their children or to steer them in the right direction. But at the end of the day, in most situations, it's going to be how it's going to be. And you might have one child that's very, very motivated to build wealth, and the other child, doesn't matter what you do, the motivation's just not there. So my view is that you position yourself so that you're ready to help that motivated child. You do everything to try and stimulate the motivation, of course, but trying to help someone that's not motivated to build wealth is a recipe for disaster. It's probably not really going to work out for you. So my view then and counsel to my clients is make smart decisions with your own money. So I guess what I'm referring to here is if you've got $275,000 of cash plus lying around, do something really smart with it for yourself. And then if you make sure your own position as parents, if we make sure our own position is as strong as it possibly is, and therefore we have surplus assets, so that is more money than we really need to enjoy a comfortable retirement. Well, when the time's right, we can do lots of different things to help our children buy a home, or we can give an early inheritance, so gradually move some of that surplus monies over to them before we pass away, or we leave it in our estate as an inheritance. But either way you cut it, your kids are going to be okay. If you know that you've got a big bundle of money that you can eventually either give them one day or you'll leave them when you pass away, they're going to be okay at the end of the day. And then secondly, you got to let your child drive their own financial decisions. Now, of course, you can encourage them, but really they need to first get a job. Then they need to be able to demonstrate that they've got good savings disciplines. And once they've ticked those two boxes, then they're ready to talk about property, I think. But you've got to learn to walk before you run. And if you take a different approach, my view is it kind of robs them of the opportunity to learn this themselves, and then robs them of the opportunity to actually get that level of satisfaction of achieving that wealth building by themselves as well. So that's the approach I'm going to take with my sons. I'm going to really encourage them, of course, like we all do as parents. And when they're ready, they've got to put in their sweat equity as well. They've got to demonstrate that, they've invested in themselves, they've got a career, they're earning income, they're making smart decisions with their money. And once they've got to that point, then we can help them. But if they can't demonstrate those fundamentals, then helping them, in my view, doesn't actually end up helping them. It might give you satisfaction as a parent, but it doesn't necessarily help them. And that's why I gave you that preamble to begin with, well, to listeners and to Tina. This is not me lecturing you on how to parent your kids, just more about, I think, creating opportunities for children to learn, young adults, to learn the fundamentals of managing money at the earliest possible age and give them that foundation. If they have that foundation, it will serve them really well throughout the rest of their life. Giving them a property or manipulating a situation where they're going to get a property, sure, that ticks one box in terms of building their wealth, but it doesn't teach them what they really need to learn in order to manage money successfully for the rest of their life. Anyway, that's my viewpoint. Maybe, as I said, I need to do a blog on it because I think it's a really popular topic. But thanks so much for your question, Tina. Okay, next question is from George. George writes, you often mention consistent capital growth as one of the rules for selecting investment grade property. I have a few suburbs in mind and would love to start sorting some properties by their growth rate over time. That is, over the past 10, 20 and 30 years. Is there a tool or website that you could recommend that allows you to use filters like that? Great thinking, George. I mean, that would potentially be useful, although I don't think it would be it'd be interesting, probably just not useful to make investment decisions. George, I'd recommend go back and listen to episode 323, which wasn't that long ago. I recorded in September 2024. I talk about one of the challenges with property data and how that property data can influence or maybe not correctly reflect how the value of the underlying land in a particular property has changed over time. So I think once you have a look at that podcast episode that'll give you a better sense of, whether that data is actually going to be useful. Because really what you're doing is looking at one data point, if you like. So if you looked at 15 Smith Street, it might have sold in 1984 and then sold again in 2024. You've only got two data sets there. You're then putting a lot of reliance that, in fact, those two transactions correctly reflected the intrinsic or technical value of that asset. And if it didn't, for a whole bunch of different reasons that I mentioned in that previous episode, then it's going to give you the wrong information. Similarly, you could get a situation where a property has been really poorly marketed, or there's been some situation in which case it's sold below intrinsic value, and then that might lead you to believe it's actually not a good asset, but it really is. So a data approach like that's just not really going to work. Maybe it might help you filter potentially some prospects, but it's still not going to be a great idea. I would actually take a different approach. I would, if you've got a few suburbs that you have in mind, I would try and identify the streets and locations. Normally in a suburb, you're going to have not all that suburb's going to be just as good as each other. You're going to have a couple of streets or a particular pocket in a suburb that is better than the rest. So I would identify those streets or locations, and then I would try and build a bit of a data set from there. So then if it was a particular street, I'd then have a look at the assets in that street and then try and build a bit of a data set from there, having regard to some of the things that I talk about in that previous episode, like, how much capital improvement in particular has occurred over time, because you're going to need to make an adjustment for that. So hopefully that helps you, George. I can imagine over the next probably only 5 years, we're going to have a lot of AI tools that are going to purport to help investors make these sorts of decisions. I'm very much looking forward to them. I think they might be very interesting, but I'll have a healthy level of skepticism about whether they're going to help you make specific investment decisions. Okay, last question today from Dominique. It's about tax. Everyone loves a good tax question. Okay, so Dominique writes, I purchased an investment property in April 2019 for $645,000, with the settlement costs, including stamp duty, being $35,000. The property was rented from April 2019, so as soon as he purchased the property, until December 2021. After the tenants vacated in December 2021, I did some repairs and maintenance and moved into the property when I got married and claimed it as my principal place of residence in February 2022. I changed the mortgage from investment to own-occupier after the tenants vacated. The property is still solely in my name. My wife and I are considering purchasing a 4-bedroom primary place of residence in both their names at the end of the year and selling my investment property. My property is valued at $900,000 with a current mortgage of $530,000. My taxable income will be $175,000 this year. I plan to seek professional advice before the end of the tax year, but would like to get an indication of the amount of capital gains tax I am likely to owe the ATO. My first question relates to the cost base for capital gains tax. Will the price I paid in 2019 be the value of the property or the value of the property in 2022 when it became my principal place of residence? I would like to know if I'm entitled to the discount of the days applied for the period it was a main residence. I enjoy listening to your podcast, especially when traveling. Okay, so thanks, Dominique. Thanks for the question. Okay, so here's the rule. If you buy a property and it becomes an investment property after settlement, so as soon as after you purchase it, it's not a primary place of residence, not a main residence, then you need to apportion the main residence exemption by the number of days that you've owned the property versus, the number of days you claimed as your home. The other situation is where you buy a property and you occupy it initially as your main residence. If then you subsequently move out, then your cost base becomes the market value. But in your situation, Dominic, as you said, you rented the property out in April 2019 when you first purchased it. So what you need to do is apportion any main resident exemption by the number of days. Okay, so let me take you through some rough numbers. You bought the property in 2019. Let's say you sell in 2024. So that's a 5-year period. You rent it out for the first 3 years and you've occupied it for the remaining or the most recent 2 years. So because you've occupied it for 2 out of 5 years, we can say that 40% of the time that you own the property, it was your main residence. if we say the cost base is what you paid for it back in April 19, 645, plus settlement costs, stamp duty, so forth, 35,000, plus it's most likely you'll be able to add the repairs and maintenance that you did prior to occupying the property to add to the cost base. You need to obviously speak to your accountant about that. If you go and sell the property, so that total cost base then is 680. If you sell the property for 900, your gross gain is $220,000. Of course, you've held the asset for more than 12 months, so you get the 50% capital gains tax discount, which takes it down to $110,000. And if you multiply that by the highest marginal tax rate, 47%, just to be conservative, it gives you a tax liability of around $52,000. However, because you can make a partial main residence claim because you have occupied it for 40% of the time, that'll knock your tax liability down to about $31,000. So roughly, based on the information you've told me, that's how I would approach that question. But, the thing is that in lots of these situations, there's always sort of idiosyncrasies or more detail with these sorts of things. So you've got to go and get some specific advice, personal advice, I should say, regarding this. But that's kind of the high level way of approaching it. And maybe a better way of expressing it would be to say, look, your liability is going to be somewhere between $30,000 and $50,000 if you sell for $900. But, if I give you that range, that might be a better way of expressing it. But thanks, Dominic, for the question. It's a good one. And thank you, everyone, for submitting your questions. It's really fantastic to have the opportunity to answer them. And until tomorrow, bye for now.